picture the underlying architecture of the American healthcare system. But don't picture it as this single unified grid.
Right, because it's definitely not that.
No, not at all. It is more of a sprawling, just highly fragmented supply chain.
Oh, absolutely.
You know, you have pharmaceutical manufacturers on one end.
And patients on the other.
Exactly. And in between, it is just this tangled web of clinics, hospitals, specialty pharmacies, home care providers, all of it.
And for the last decade, I mean, the operational mandate for anyone sitting in that middle space has been brutally simple.
Just survive.
Survive the margin compression, yeah.
Because with labor costs just, structurally inflated by clinical shortages.
Right. Nurses and pharmacists are so hard to retain right now.
Exactly. And then you have reimbursement rates constantly under pressure from both private payers and the federal government.
So simply maintaining your profit margins in that environment is considered a huge victory.
Right. But when you look at the Q2 2026 earnings call from BrightSpring Health Services, their ticker symbol is BTSG for anyone tracking. Yeah, you don't see a company merely surviving that compression.
No, you really don't.
You see this massive vertically integrated operator that is actively accelerating through those headwinds.
Using specialized pharmacy distribution and home health density as their leverage.
Exactly. So today we are going to unpack the mechanics of that strategy.
It forces a total recalibration of how we view scale in this sector, honestly.
Yeah, because when an operator of that size manages to expand its margins in a macroeconomic environment that is literally designed to squeeze them,
it suggests they found a structural advantage.
Exactly. A real advantage in how they route patients and distribute these really complex therapies.
And the earnings call we are looking at today, which covers their performance through July of 2026, it really strips away the usual healthcare marketing rhetoric.
Yeah, we are getting into the actual numbers. Our source material today is the unedited transcript of BrightSpring's Q2 earnings call,
anchored by their CEO, John Rousseau, and CFO, Jennifer Phipps.
Plus the accompanying executive summary notes. And our mission for this deep dive is to dissect the operational architecture that actually produced these numbers.
Because we want to understand the physical and digital infrastructure driving their revenue leap, right?
Right. And their strategic pivot in their specialty pharmacy portfolio, plus what their forward guidance tells us about the broader migration of high acuity care into the home.
I love looking at earnings calls because they are the ultimate reality check.
Oh, for sure.
The management team has to sit there and defend their operational thesis against, the brutal scrutiny of institutional analysts.
There is no room for abstraction.
None. It is purely about cash flow, margin defense, and capital allocation.
Okay, so let's get right into the financial architecture of this quarter because the top line volume is just immense.
It really is.
We're looking at net revenue of roughly $3.9 billion for the quarter.
Almost $4 billion in one quarter.
Right. That is a 23% year-over-year growth rate.
Which is huge for a company this mature.
But what makes this call stand out isn't just the sheer accumulation of top-line revenue. It is how efficiently they process that volume into profit.
Yeah, the flow-through is what matters.
Exactly. Their adjusted EBITDA hit just over $205 million, which is a 34% jump.
A 44% jump in EBITDA on 23% revenue growth.
Right. And the critical metric, the one that really signals operational leverage, is the 80 basis point expansion in their EBITDA margin,
bringing it to 5.3%.
Yeah.
And that 80 basis point expansion on nearly $4 billion in quarterly revenue, that is the central plot point of this entire earnings release.
Why is that so crucial to point out?
Because in this sector, achieving that kind of margin expansion while growing the top line by 23% is notoriously difficult.
Because usually growth hurts margins at first, right?
Exactly. Usually when a healthcare operator scales that rapidly, their margins contract in the short term. They are absorbing all the friction costs of integration.
Like hiring sprees, migrating IT systems.
Yeah, establishing new geographic footholds.
Yeah.
It all costs money up front.
So the fact that BrightSpring's EBITDA grew nearly twice as fast as their revenue,
it indicates they are achieving true economies of scale. They are driving more volume through their existing fixed cost infrastructure without having to, proportionally increase their variable administrative overhead.
That makes sense. And you see that leverage most clearly when you break down their business segments.
Yeah, you really have to look at the individual engines.
The absolute engine of this operation, like the core of it, is the Pharmacy Solutions division.
Oh, without a doubt.
That segment alone pulled in roughly $3.4 billion, growing 22% year over year. I mean, it accounts for the vast majority of their overall revenue.
It acts as the high-velocity cash generator for the entire enterprise.
Right.
When you have a pharmacy division operating at that scale, it provides the underlying financial stability that allows the company to be aggressive in other higher margin but maybe more capital-intensive areas of the business.
But looking at the sheer volume of that pharmacy growth, we have to question the underlying composition, don't we?
We do.
Because a 22% growth rate on a multi-billion-dollar base is massive. So the question is this the result of organic operational excellence, like actually winning market share and improving unit economics? Or are we just looking at the aggregate volume of recent market expansions masking underlying inefficiencies?
That's the billion-dollar question. If you just keep buying up distribution channels, your revenue obviously goes up.
Right. But it doesn't mean your core machine is running any better.
Exactly. So to determine the quality of that growth, we have to analyze the specific type of product they are distributing.
Because this isn't just your corner retail pharmacy volume.
No, not at all. The catalyst driving that $3.4 billion engine is their specialty and infusion portfolio.
Okay, let's dig into that.
Within that segment, revenue hit $2.9 billion, up 30%.
Wow.
And crucially, this wasn't driven by arbitrary price hikes on existing drugs.
Right, it wasn't just inflation.
No, it was driven by a 31% increase in actual prescription volume. The underlying fuel here is their aggressive expansion into limited distribution drugs, or LDDs.
Okay, the LDD portfolio. That is where the operational moat actually exists for them.
Absolutely.
BrightSpring announced they now have 155 total LDDs in their portfolio. And just in the first half of 2026 alone, they launched 12 new ones.
That's a rapid pace of acquisition for these contracts.
It really is.
Yeah.
And 4 of those are entirely exclusive to BrightSpring, and 8 are categorized as ultra-narrow network.
Yeah, we should explain that because this is like the velvet rope of the pharmaceutical supply chain.
I love that analogy, the velvet rope.
Manufacturers don't just hand these drugs over to regional distributors. They require extreme logistical precision.
Right.
The barrier to entry for an LDD contract is immense. These are high acuity, deeply complex biological therapies.
We aren't just putting pills in a bottle.
Exactly. They often require strict cold chain storage. That means the temperature has to be monitored from the moment it leaves the manufacturing facility to the moment it is administered in the patient's home.
If the temperature drops or spikes even a little,
the drug is ruined.
Wow.
But physical logistics are just the baseline. What pharmaceutical manufacturers are actually paying for when they grant an LDD contract to someone like BrightSpring is data and adherence.
They call them wraparound services, right?
Yes.
The pill itself is almost secondary to the infrastructure built around it.
Precisely. Think about it from the manufacturer's perspective. If they have spent $1 billion developing an orphan drug, the absolute worst case scenario is that a patient gets prescribed the drug, experiences some minor side effect, gets scared, and just stops taking it.
Because then the manufacturer loses the recurring revenue.
And the patient loses the clinical benefit.
Right, everybody loses.
Exactly. So to win an LDD contract, an operator like BrightSpring has to prove they can deploy specialized nursing teams, dedicated patient contact centers, and real-time biometric monitoring to ensure that patient stays on the therapy.
They have to handhold the patient through the whole process.
And they have to feed all that adherence data directly back to the manufacturer.
And the adherence metrics they cited on the call are actually pretty telling. They reported a 93% medication possession ratio.
Which is phenomenally high.
Yeah, that means patients actually have the drug on hand and are refilling it 93% of the time, which for complex therapies is just incredible.
It is.
They also highlighted a time to first fill of just 3.7 days.
Which is another massive competitive advantage.
Right, because anyone who has dealt with prior authorizations in the US knows it can take weeks.
Easily.
But when a patient is diagnosed with a severe, potentially terminal condition, waiting weeks for a prior authorization to clear is completely unacceptable.
It can be a matter of life and death.
So that 3.7-day turnaround is a massive selling point to the prescribing oncologists and specialists, I would imagine.
Oh, absolutely. And that speed directly impacts the clinical outcome. But, John Rousseau highlighted a strategic shift in their LDD acquisition strategy on this call that carries some really significant implications.
Yeah, the pivot away from just oncology.
Exactly. Historically, BrightSpring built its LDD dominance on branded oncology therapies. And oncology is this massive established market with very well understood referral pathways.
Right. Cancer treatment is a huge lane.
But Rousseau noted that their most significant recent LDD wins and their primary focus moving forward are actually outside of oncology, specifically targeting rare and orphan diseases.
And this is where I really struggle with their capital allocation strategy, to be honest.
Why is that?
Well, I understand the desire to diversify away from purely oncology, but pivoting into rare and orphan diseases fundamentally alters their unit economics.
It does.
By definition, a rare disease has a minuscule patient population in the U.S.
Sometimes just a few thousand people.
Exactly. So you are building out this incredibly expensive, highly customized wraparound infrastructure like specialized call centers, specific cold chain routes, bespoke nursing protocols for a drug that might only treat a few thousand people nationwide. Doesn't that significantly increase their customer acquisition cost and operational risk compared to just sticking with the broader oncology market?
It absolutely increases the upfront logistical friction. There is no denying that. But the back-end economic moat is substantially deeper.
How so?
While the total addressable market for a specific orphan drug is really small, the retention rate and the lifetime value of that patient are incredibly high.
Because it's a chronic issue.
Right. These are often lifelong genetic conditions. Furthermore, because the patient population is so small, manufacturers usually limit the distribution to an ultra-narrow network. Sometimes just 2 or 3 specialty pharmacies in the entire country get access.
So if BrightSpring secures one of those slots, they effectively capture a guaranteed monopoly on a segment of that patient population.
Exactly. And once you build the infrastructure for one rare disease, the marginal cost of adding a second or third rare disease LDD drops significantly.
Because the nurses in the call centers are already in place.
Exactly. During the analyst Q&A, Matthew Gilmore brought up this exact concern regarding the cost of pivoting into rare diseases.
Yeah, it's a very natural question to ask.
And Rousseau's response was super illuminating regarding their structural advantage. He pointed out that BrightSpring doesn't have to build a new sales force from scratch to target these specialized prescribers.
Right.
They already have hundreds of clinical liaisons deeply embedded in thousands of specialist offices across the country. They are simply leveraging their existing distribution pipes to push a new, higher-margin product.
The sunk costs of the infrastructure are already paid for.
Exactly. Adding orphan LDDs is just an exercise in maximizing the throughput of those existing pipes.
So the specialty pharmacy side of the house is humming, leveraging these exclusive networks to drive massive volume.
It's a great position to be in.
But we can't look at the pharmacy division as a monolith, because the other segment, home and community pharmacy, is facing a pretty severe contraction.
Yeah, this was the pain point in the quarter.
Revenue in that segment dropped to $540 million, which is an 8% decline year over year.
And this brings us to the most significant external variable impacting their operational model right now.
The regulatory environment.
Specifically, the ongoing ripple effects of the Inflation Reduction Act, or the IRA.
And the structural mechanics of how the IRA impacts pharmacy operators are frankly brutal.
They really are.
BrightSpring projected a $200 million revenue headwind for the full year of 2026, entirely due to IRA implementation.
$200 million, just gone.
Yeah. And that $200 million top line hit cascades down to a projected $15 million hole in their EBITDA.
We need to dissect the mechanical flow of that revenue hit, just so listeners understand what's happening without getting into the politics of it.
Right, strictly from an operational perspective.
Exactly. The IRA granted Medicare the authority to directly negotiate the prices of certain high-spend drugs.
The government is stepping in to say, we won't pay X, we will only pay Y.
Right. When CMS, the Centers for Medicare and Medicaid Services, forces a price reduction from the manufacturer, that lower valuation resets the reimbursement rates across the entire supply chain.
So everyone downstream makes less money.
Exactly. As a pharmacy operator dispensing these specific medications to Medicare beneficiaries, BrightSpring is suddenly processing the exact same volume of pills, utilizing the exact same labor and logistical infrastructure.
But they're collecting significantly less top-line revenue per script.
Exactly. It is a purely exogenous shock.
The government simply turns a dial, And $200 million in revenue just evaporates from the income statement.
Rousseau was visibly frustrated on the call. He referred to it as dealing with the unintended consequences of the legislative rollout.
But the strategic response from the management team is what really demands our analysis here. Because CFO Jennifer Phipps noted that if you back out the artificial IRA impact, the core home and community pharmacy EBITDA actually grew year over year.
Which is wild.
Yeah. How does a company absorb a $15 million profit deficit purely through operational efficiency?
Well, it requires an aggressive optimization of the customer base. You cannot simply outgrow a structural reimbursement cut of that magnitude. You have to fundamentally change your cost of service.
Right.
Phipps and Rousseau detailed two primary levers they pulled. The first was an intentional, calculated exit from specific contracts.
They just walked away.
Yes. They actively chose to walk away from certain skilled nursing facilities that they deemed uneconomic.
That is a fascinating dynamic to me. In a growth-obsessed market, willingly shedding top-line revenue to protect your margin profile takes immense discipline.
It does.
Because if a specific skilled nursing facility requires really high-touch delivery logistics, but the IRA has compressed the reimbursement rate for the drugs those patients need, the contract just becomes a liability.
Exactly. They essentially fired their unprofitable clients.
Wow.
It is the only rational move. And the second lever was a massive deployment of internal automation to strip out administrative labor costs, which we are definitely going to analyze in depth later.
Definitely.
But there is a really vital forward-looking data point regarding this IRA headwind that listeners need to know.
What's that?
Phipps indicated that the bleeding is largely contained to this current cycle.
Oh, really?
Yeah, because the initial round of Medicare negotiations targeted the absolute highest spend, highest volume drugs. So the marginal impact of future negotiations inherently diminishes.
Ah, that makes sense. They ripped the biggest Band-Aid off first.
Exactly. She estimated that the projected IRA headwind for 2027 will be roughly 50% of what they're absorbing in 2026.
Okay, so the shock to the system is heavily front-loaded. But I have to challenge the narrative here for a second.
Go for it.
Can you really just efficiency your way out of a $200 million revenue hole? Because if the government compresses your margin and your response is to just squeeze the underlying operations, automating processes, cutting overhead, dropping lower margin contracts, where is the breaking point?
It's a fair question.
Pharmacy distribution is inherently a clinical exercise. It is about getting the exact right molecular compound to the right human being at the exact right time.
Yes, the stakes are very real.
So at what point does stripping out administrative friction bleed into compromising actual clinical oversight?
That is the perpetual tension in healthcare operations. You are always balancing margin with patient safety. However, the internal quality metrics BrightSpring reported for this segment suggest they have not yet breached that threshold.
What were the numbers?
They reported a dispensing accuracy rate of 99.98%.
Okay, that's practically perfect.
Their order completeness sits at 99%, and their on-time delivery rate is 94.3%.
Okay, so maintaining those quality metrics while simultaneously absorbing that level of margin compression, that really is a testament to their underlying logistics engine.
It really is.
Yeah.
But to fully grasp how they delivered a massive earnings beat despite the IRA dragging down a huge chunk of their pharmacy business, we have to look at the structural counterbalance in their portfolio.
The provider services division.
Exactly. The provider services segment is the physical manifestation of, honestly, the most powerful secular trend in healthcare right now, the migration of high acuity care away from institutional settings and into the home.
And the growth metrics here are just staggering. Provider services revenue hit $466 million, representing a 30% year-over-year growth rate.
Massive.
And the absolute standout within that segment is home healthcare, which generated $278 million. That's a 51% growth rate.
51%. That's the number that institutional investors are anchoring on.
Right. We also saw a steady incremental growth in rehab care, which was up 12% to $82 million, and personal care up 7% to $107 million.
But a significant catalyst for that home health explosion was actually their inorganic growth strategy. Specifically, the integration of branch assets they acquired from Amedisys and LHC group.
Right, they bought up a bunch of existing footprint.
Yeah, those acquired geographic footprints contributed $78 million in revenue and $8 million in EBITDA in just the second quarter alone.
And this is where we really need to examine execution risk.
Absolutely. Integration is hard.
Because acquiring local home health branches from massive competitors like Amedisys isn't just about, like, transferring real estate leases. It is about integrating disparate EMR systems, absorbing new clinical cultures, rerouting local referral networks.
Right, it's very messy on the ground.
The friction involved in that kind of integration usually drags down near-term earnings pretty hard. Yet BrightSpring's management team actually revised their forward expectations upward on this call.
They did.
They now project those acquired assets will generate $35 million in EBITDA for the full year of 2026.
Which signals that the integration was remarkably seamless. And that implies their central IT and operational infrastructure is highly modular.
They can just plug and play.
Exactly. They can plug new geographic nodes into their network without breaking the underlying system.
I see the immediate value of acquiring that density, but I have to question the long-term trajectory. A 51% growth rate in home health is totally anomalous.
It won't stay that high forever, no.
Once those Amedisys and LHC branches are fully annualized and baked into the year-over-year comparables, what happens to that growth curve? Does this engine just stall out when it has to rely purely on organic market share capture rather than just buying up branches?
That is the critical distinction between a company that merely rolls up assets to look big and a company that fundamentally alters the referral pathways in its local market.
Okay, unpack that.
The Amedisys acquisitions provided the geographic density, but their organic growth strategy is what will actually sustain the momentum. And that organic strategy is built almost entirely on their ground game inside the hospital systems.
Liaisons.
Yes. Rousseau revealed that BrightSpring has deployed roughly 1,000 clinical liaisons nationwide.
Let's break down the actual mechanics of that liaison strategy, because 1,000 embedded clinical personnel is a massive fixed cost. I mean, how does a liaison actually generate return on investment for them?
A clinical liaison operates at the absolute most critical choke point of the healthcare system. The hospital discharge.
The moment the patient leaves the building.
Exactly. When a patient is recovering from an acute event, say a stroke or a major orthopedic surgery, the hospital's primary goal is to discharge them safely to avoid a readmission.
Because readmissions destroy hospital margins.
And they trigger severe CMS penalties. But the hospital discharge planner is usually completely overwhelmed. They are trying to figure out which local home health agency actually has the capacity to take the patient, which agency accepts their specific insurance, and whether that agency can coordinate the necessary specialty pharmacy drops.
It is a logistical nightmare for the hospital.
It's a total mess. So BrightSpring embeds a clinical liaison directly into the hospital's workflow.
Just sitting right there at the desk with them.
Essentially, yes. The liaison approaches the discharge planner and basically says, hey, we have a home health nurse available tomorrow morning. We already have their specialty medications routed through our LDD pharmacy network, and we will handle all the complex prior authorizations. Just hand the patient to us.
Wow. They remove all the friction.
They remove the friction from the discharge process. By solving the hospital's throughput problem, BrightSpring captures the patient volume.
They are essentially operating as an outsourced, free discharge planning service for the hospital. But in exchange, they capture the lifetime value of that patient's post-acute care.
Precisely. And they are aggressively targeting accountable care organizations, or ACOs, with this exact pitch.
Explain what an ACO is for the listeners who might not be familiar.
Sure. ACOs are groups of doctors and hospitals that voluntarily assume the financial risk for a patient population. If the ACO keeps the patient healthy and out of the emergency room, they share in the savings generated for Medicare.
So they are highly incentivized to get this right.
Exactly. And BrightSpring's pitch to an ACO is entirely based on their vertically integrated model. They can guarantee that the home health nurse and the specialty pharmacy are operating on the same data platform, ensuring the patient actually takes their medication and avoids a costly bounce back to the ER.
And the clinical data supports that pitch, right?
It does. They cited a 99% timely initiation of care metric in home health.
Wow. So 99% of the time, the BrightSpring nurse is standing in the patient's living room exactly when the hospital discharge orders mandated.
Yep. Furthermore, their CHPS score, which is the standardized metric for patient satisfaction, sits at 89% for their overall hospice rating.
The operational synergy here is just profound. The pharmacy division generates the massive cash flow, which funds the acquisition of home health density and the deployment of those 1,000 clinical liaisons.
Right.
And then those liaisons capture the hospital discharge volume, which feeds patients into the home health branches.
And those home health patients inevitably require complex medications,
which feeds volume right back into the pharmacy division. It is a completely closed-loop ecosystem.
It's a brilliant theoretical model, truly.
But deploying that level of infrastructure requires immense capital. And this brings us to the financial foundation of the entire enterprise. How are they structuring their balance sheet to fund this aggressive expansion without over-leveraging the operations?
Capital structure is the invisible architecture that either enables a company's strategy or ultimately suffocates it.
Yeah, debt can sink a great operational plan very quickly.
Exactly. And BrightSpring's balance sheet maneuvers in the first half of 2026 were highly aggressive, but very precisely executed.
Let's look at the raw numbers. They ended Q2 with $1.7 billion in net debt.
Which is a big number.
To the retail observer, $1.7 billion in debt in a relatively high interest rate environment looks like a massive vulnerability.
It does. However, the critical metric is leverage the ratio of that debt to their earnings power.
Right, the multiple.
BrightSpring successfully drove their net leverage down to 2.15 times by the end of Q2, which is a significant reduction from 2.4 times just a quarter prior.
That pace of deleveraging is remarkable.
It really is. The primary catalyst for that reduction was a strategic portfolio optimization. In March of 2026, they completely divested their community living business.
That divestiture is fascinating me. Why sell off an entire division when you were actively trying to build scale everywhere else?
Because not all revenue is created equal.
True.
The community living business, which involves managing group homes and intermediate care facilities, is highly labor-intensive, heavily regulated at the state level, and generally operates at a much lower margin profile than specialty pharmacy or high-acuity home health.
So it was dragging down their averages.
Exactly. By shedding that asset, they instantly eliminated a drag on their consolidated margins. But more importantly, they took the proceeds from that sale and immediately extinguished a $300 million term loan.
They traded a low-margin, high-friction operational asset for immediate balance sheet flexibility.
And that deleveraging allowed them to execute the most impressive financial engineering move of the quarter. Because their risk profile dropped significantly, they went back to their syndication of lenders and successfully refinanced the remaining debt structure.
They negotiated a better rate.
They lowered their interest rate spread by 50 basis points.
So the mechanics of that refinance provide massive cash flow relief. Their original debt was priced at SOFR plus 325 basis points. By dropping that to SOFR plus 200, they're essentially saving 0.5% in pure interest expense across a multi-billion-dollar debt load.
That isn't just an accounting trick. That is millions of dollars in hard cash that previously went straight to banks and can now be redirected into operations or acquisitions.
And the institutional credit markets validated the strategy too. Both S&P and Moody's upgraded BrightSpring's credit ratings during the quarter, moving to BB and B3, respectively.
Those upgrades functionally lower their cost of capital for any future borrowing they might do.
It creates a really powerful flywheel effect. Lower leverage leads to credit upgrades, which leads to cheaper debt, which increases free cash flow, which allows for faster debt repayment or further acquisitions.
Exactly. And they are allocating that free cash flow aggressively. While paying down debt, they simultaneously executed $120 million in share repurchases year to date.
So they're operating a multi-pronged capital allocation strategy, extinguishing expensive debt, buying back equity to boost earnings per share, and funding their M&A pipeline.
The discipline of that M&A pipeline is really what distinguishes their current management team. John Rousseau was very explicit on the call regarding their acquisition philosophy.
What did he say?
He noted a robust pipeline of targets, but explicitly stated they are actively avoiding the massive, overpriced platform acquisitions that some of their competitors are pursuing.
Yeah, he referenced competitors doing goofy things on valuations.
Right, specifically calling out operators paying 20 times EBITDA for assets.
Paying 20 times EBITDA in this rate environment requires a belief in flawless integration and massive immediate synergies, which, let's be real, almost never materialize.
And never. So BrightSpring is entirely focused on tuck-in acquisitions.
Explain a tuck-in strategy.
A tuck-in strategy is essentially acquiring localized density without paying a premium for a competitor's corporate overhead.
Okay.
So if BrightSpring already operates a pharmacy hub and a home health branch in a specific metropolitan statistical area, they don't need to buy a massive regional competitor. They just need to buy smaller independent home health agencies in adjacent zip codes.
They just tuck them into what they already have.
Exactly. They fold those newly acquired clinical teams into their existing IT and administrative infrastructure, instantly improving the margin profile of the acquired asset.
But I have to push back on the idea that they have completely de-risked the balance sheet.
Oh, there is still risk.
Yes, they lowered leverage, and yes, they secured credit upgrades, but $1.7 billion in debt is still an immense obligation for any company.
It is.
If their aggressive push into rare disease LDDs fails to generate the projected volume, or if the federal government implements a broader, more aggressive version of the IRA that compresses pharmacy margins even further, that 2.15 times leverage ratio could spike very rapidly.
Absolutely it could.
So are they truly insulated from macro shocks, or are they operating on a razor-thin margin of error here?
The ultimate shock absorber for any leveraged capital structure is operating cash flow. If a company carries heavy debt but generates anemic cash flow, they are highly vulnerable to macro shocks. However, CFO Jennifer Phipps outlined a cash flow profile that provides massive operational padding.
What were the numbers there?
She guided for approximately $600 million in operating cash flow for the full year of 2026.
$600 million in pure cash generation.
Exactly. And she noted an EBITDA to cash conversion rate hovering around 70%.
Which means their earnings aren't just tied up in massive capital expenditures or trapped in bloated accounts receivable.
The profits are quickly converting to liquid cash. When you are throwing off $600 million in cash annually, you have the internal liquidity to service that $1.7 billion debt load, fund your tuck-in M&A pipeline without even tapping the credit markets, and absorb external regulatory shocks like the IRA headwinds.
So the debt is a highly optimized tool for them, not an existential threat.
Exactly.
Okay, the financial engineering is impressive, but it ultimately relies on a physical workforce to execute the clinical care.
Humans have to do the work.
Right. You cannot run a $15 billion healthcare network using only algorithms and balance sheet restructuring. You need pharmacists, nurses, physical therapists, and clinical liaisons.
And the macro environment for clinical staffing right now in 2026 is bordering on catastrophic across the industry.
Burnout rates are staggering, and wage inflation's just relentless. Yet the narrative coming from BrightSpring's management team completely contradicts the broader industry trend.
It is honestly the most counterintuitive data point in the entire earnings report. Management stated that clinician retention across their diverse service lines is currently sitting at all-time highs and operating at best practice levels.
Achieving all-time high retention in an industry that is actively hemorrhaging clinical talent is a massive structural advantage.
It completely insulates them from the exorbitant costs of contract nursing and recruiting fees that are just destroying the margins of their competitors.
Analyst Jared Haas from William Blair actually keyed in on this exact dynamic during the Q&A, asking how they are seemingly defying gravity on staffing.
And John Rousseau attributed the retention to a tripartite strategy. The first two elements are relatively standard, ensuring compensation and benefits are highly competitive, and fostering a mission-driven culture where clinicians feel deeply connected to the outcome of keeping patients out of institutional care.
Standard corporate playbook stuff.
Right. However, the third element is where BrightSpring is fundamentally altering the day-to-day reality of their workforce. They are aggressively deploying administrative technology and artificial intelligence to eradicate clinical friction.
We have to analyze the actual source of clinical burnout to understand why this is effective. Nurses and pharmacists do not burn out because they dislike interacting with patients.
No, they got into the field to help patients.
Exactly. They burn out because the modern healthcare system forces them to spend nearly half their shift acting as data entry clerks.
They are fighting with archaic electronic medical records, endlessly documenting compliance metrics, arguing with payers over prior authorizations.
So BrightSpring recognized that the most effective way to retain a clinician is to allow them to practice at the absolute top of their license.
Yes. They have integrated AI tools across the entire patient life cycle. They use AI for initial patient intake, drastically reducing the time a nurse spends gathering demographic and historical data.
Oh, that's huge.
They deploy algorithms for complex medication reviews, instantly flagging potential adverse interactions across massive patient profiles. They are even utilizing generative models to assist in drafting patient care plans and streamlining documentation.
They are essentially using AI to strip out the administrative bloat. allowing the clinician to spend their time actually engaged in high acuity care.
But they are pairing this AI rollout with an operational philosophy borrowed from a completely different industry. Rousseau highlighted that they now have nearly 300 employees certified in Lean Six Sigma across the enterprise.
Okay, the integration of Lean Six Sigma, which is a methodology originally developed by Motorola and Toyota to eliminate waste and variance in industrial manufacturing, into a home, health, and specialty pharmacy setting, is a fascinating crossover.
It really is an evolution of clinical operations.
But how does an industrial manufacturing philosophy actually translate to a nurse driving to a patient's house?
Think about it this way. In a fragmented home health model, variance is the enemy of margin. If a nurse in Ohio spends 30 minutes every morning searching for specific wound care supplies in a disorganized supply closet, and a nurse in Florida spends 45 minutes navigating inefficient routing between patient homes, that variance destroys the unit economics of the visit.
Ah, I see.
Lean Six Sigma treats those inefficiencies as defects in the operational process. BrightSpring is using these certified engineers to standardize the background logistics, inventory management, route optimization, pre-visit sharding across all their localized branches.
They are creating a highly standardized, waste-free operational chassis. But I see a significant philosophical risk here. If you apply the rigid, defect-obsessed methodology of a Toyota assembly line to the deeply human, unpredictable reality of home healthcare, do you risk commoditizing the patient experience?
That's a very real concern.
Does standardizing the workflow eventually strip away the empathy and flexibility required to treat complex, highly anxious patients in their own homes?
If Lean Six Sigma is misapplied to dictate the actual clinical interaction itself, it absolutely risks dehumanizing the care. However, the objective of deploying Lean in this context is to standardize the logistics to protect the clinical interaction.
Make the background invisible so the foreground can shine.
Exactly. If the AI handles the prior authorization and the Lean routing algorithms ensure the nurse arrives efficiently with the exact correct supplies, that nurse is significantly less stressed.
They aren't rushing to make up for lost time.
They can sit at the patient's kitchen table, fully focused on the human being in front of them, without staring at a tablet trying to complete redundant documentation. The standardization of the background operations is precisely what enables personalized, empathetic care in the foreground.
The patient satisfaction metrics, the 89% CHPS rating and rehab satisfaction scores exceeding 97%, those numbers strongly suggest that the human element is not being compromised by the algorithmic efficiency.
So the workforce is stable, the balance sheet is highly liquid, the logistics are optimized, and the organic referral pathways are expanding. Which brings us to the ultimate synthesis of the earnings call, the forward guidance.
The guidance is where the management team transitions from explaining past performance to staking their credibility on future execution.
And BrightSpring issued a massive statement of confidence for the remainder of 2026.
They really raised the floor on their full-year projections. They updated their 2026 revenue guidance to a range of $15.1 billion to $15.425 billion.
That implies a 17 to 19.5% annual growth rate on a massive baseline.
But the adjusted EBITDA guidance is what really signals their belief in their margin expansion story. They are projecting full-year adjusted EBITDA between $820 million and $845 million.
That represents a 32.8 to 36.8% growth rate over the previous year.
To project nearly 35% profit growth at a $15 billion revenue scale implies that the management team views the operational leverage achieved in Q2 not as a temporary anomaly, but as the new sustainable baseline for the enterprise.
It is an incredibly aggressive projection, but they have a significant macroeconomic tailwind forming to support it, specifically on the provider services side.
Let's talk about that tailwind.
Earlier in July, CMS released their preliminary payment rates for 2027 home health services. Crucially, for the first time in several years, those preliminary rates show a positive annual payment update.
After years of absorbing flat funding or outright Medicare cuts in a highly inflationary labor environment, a positive rate update from CMS is a massive catalyst.
It essentially expands the margin profile of their fastest-growing division without them having to change a single internal process.
It provides tremendous runway.
Alongside those regulatory tailwinds, Rousseau outlined an aggressive organic expansion plan for the pharmacy division, specifically targeting their Infusion business.
He stated a long-term goal to enter 12 to 15 additional states over the next 5 years, building de novo infusion suites and expanding their specialized LDD distribution footprint.
But I look at this guidance projecting 35% EBITDA growth assuming the Amedisys integration continues flawlessly, banking on the aggressive expansion into 15 new infusion markets, and anticipating the CMS rate increase holds, and I have to question if they are pricing in absolute operational perfection.
Right. What happens if they encounter unexpected state-level regulatory friction in those new infusion markets? Or what if the deployment of their AI algorithms hits a snag in compliance reporting?
When you guide for 35% profit growth at this scale, any minor operational stumble is severely punished by the market. Pricing imperfection absolutely reduces the margin of error.
During the call, analyst Stephen Baxter from Wells Fargo probed for potential macro vulnerabilities, specifically inquiring about the potential for new generic drug tariffs in the coming years.
And tariffs would introduce massive volatility into their supply chain.
They would. CFO Jennifer Phipps acknowledged the variable, noting that while the current administration has delayed potential generic tariffs until 2028, it remains a looming threat to pharmacy margins.
However, Rousseau pointed out that their sheer scale provides a structural defense. Having spent a decade building a multi-billion-dollar procurement engine, they have the vendor diversification and purchasing power to shift sourcing and mitigate regional pricing shocks.
They aren't reliant on a single supply node.
Exactly. Ultimately, their defense against operational stumbles is their diversification. If the pharmacy expansion slows, the home health density compensates. If home health integration lags, the LDD portfolio drives the margin.
The hybrid engine model provides the necessary redundancy.
It really does.
We have covered an immense amount of operational architecture today. Let's synthesize the core thesis of this quarter.
Okay, let's wrap it up.
BrightSpring Health Services delivered a massive earnings beat by fundamentally leveraging scale in two highly complex sectors. In pharmacy, they're utilizing ultra-narrow, limited distribution drug networks and specialized cold chain logistics to build a high-margin moat, successfully offsetting $200 million in legislative headwinds from the IRA by ruthlessly optimizing their customer base.
And in provider services, they're capitalizing on the secular shift toward home-based care by integrating major acquisitions, deploying an army of 1,000 clinical liaisons to capture hospital discharge volume, and utilizing AI and Lean Six Sigma to eradicate administrative friction and protect their clinical workforce from burnout.
And they are executing all of this while actively deleveraging a $1.7 billion balance sheet, securing credit upgrades, and driving $600 million in operating cash flow.
It's an operational masterclass.
The reason this matters to you, the listener, whether you are analyzing the sector for capital allocation, operating a clinical practice, or simply observing the evolution of the system, is because BrightSpring is actively writing the blueprint for the next decade of American healthcare.
Absolutely. The fragmented, decentralized model of independent clinics and regional pharmacies is being replaced by massive, vertically integrated platforms that can control the entire patient journey from hospital discharge all the way to home infusion.
That vertical integration is undeniably efficient, but it forces us to confront a larger structural consequence. As operators like BrightSpring reach this level of scale-wielding, multi-billion-dollar balance sheets, proprietary AI intake algorithms, embedded hospital liaisons, and exclusive monopolies on life-saving LDDs, the barrier to entry for anyone else becomes almost insurmountable.
We really have to ask, are we witnessing the inevitable algorithmic consolidation or Amazonification of healthcare?
And if the entire ecosystem is eventually optimized by these massive Lean Six Sigma-driven platforms, what happens to the complex outlier patients whose needs defy standardization and just fall outside the parameters of the algorithm?
It is a profound structural question about the future of patient access in a highly consolidated market.
We will leave you to consider the implications of that scale. Thank you for joining us on this deep dive into the underlying mechanics of the healthcare supply chain. Keep interrogating the operational reality behind the headline numbers, and we will catch you on the next deep dive.